Okay, now we're looking at some separate allocation, and this is allocating wages. And this is a diary of one clerk, and we want to allocate her annual wages between two departments. So she's worked 51 hours selling jewelry, 6 hours stocking jewelry, 12 hours selling hosiery, 7 hours stocking, and she has idle time. And her total wages are $30,000. So we're trying to decide how to allocate this on an annual basis, and we've just selected this group of wages, hours, as a sample. So she's worked a total of 57 hours in hosiery and 19 hours, 57 in jewelry and 19 hours in hosiery for a total of 76 hours. We don't include this idle time. That is going to be taken into consideration in another way, or maybe even ignored, because that's just a factor of doing business. So now these are our hours, and this is the total. We need to get a percentage or a ratio, an allocation base. So she spends 75% of her time in jewelry and 25% of her time in hosiery. How did I find that? I divided 57 by 76 and 19 by 76 to come up with these totals. Now I just multiply it times her wages and come up with an allocation annually of $22,500 for jewelry and $7,500 for hosiery. So that's one way of allocating, time spent. Here's another way of looking at what we're doing. In this case, this company is thinking about, they make guitars, and they're looking at their electric guitars and find out it's losing money. So they're thinking, maybe we should, not make those. So what you have to look at is that true, okay? Because of the way we're allocating things, possibly this division may still be contributing to our fixed income. So what happens if I separate these two out? So let's look at this. So acoustical, we are selling, and let's just separate them out so we know. We have sales of $5,000. We have cost of goods sold of $55,000, and we have a gross of $56,000. Same thing, we can just copy that down here. So now what are our direct expenses? So we're looking at salaries, and we're looking at supplies, and we have a total and depreciation, which is of $29,000. If we look here, it's kind of breaking down a little bit different, right? So the acoustical is taking more direct expenses than the electric. So this department contributes how much to overhead? So this is how much it contributes to the overhead. So now I can pull this on down, and not taking that into consideration, what would happen if we stopped making the electrical? So together they create a contribution of $41,489. Now, if we take the direct expenses, total indirect, we find out we have this net income of the two of $99,920. Okay, as you look at this, because if you net these two, that's what you have. What happens if I take this out? It contributes more than the loss, okay? If I take that $14,000 contribution out, we're going to have a loss here, aren't we? So if I just take that out, that's going to affect. And if you break these down, you find out, oh, well, even though it's losing $200, it is contributing to the overhead. And if I take that out, then I'm going to be in a loss situation of $5,000. So looking at divisions is really important, and their contribution to the overhead is extremely important. One way of doing it. Here is one that we talk about, rate of return. And we want to, I spelled that wrong, guys. Sorry about that. We want to figure out electronics and sports. How much are they actually contributing to the rate of return on investments for each department? And to calculate that, we have the average invested assets, and we have the sales, and we have the income. So income is a contribution to invested assets. What are we getting? If I divide my income on both situations by what their average invested assets are, it's going to give me a rate of return on investments. And we find that the electronics department has an 18% return, and the sporting goods department has a 17% return. So this is a higher, rate of return. 17%, if that's over what the company requires, is not a bad return either. And let's assume that they have a target income of $12,000. And they need that to be, too many A's, they need at least a 12% return on the assets. So if I multiply that times 12%, I find out I need to have 1,920,000 and 1,420,000. So what is my income here? So I'm meeting, I think, the goal on both cases, because my income, if you look here, is 2,880,000 and 2,040,000. The target income to get that 12% return, and obviously that's over it because you're already getting 18 and 17%. So you have what they call a residual, and this is more of a terminology thing for you than anything, a residual income over what is required of 960 and 600,000. So kind of a nice, neat, compact way of making sure you're getting the rate of return that you want. And here is, we're looking at profit margin. My guess is you can figure this one. We have sales and expenses and income. And we know sales is 100%, right? And so what is expenses? A portion of, it's 95% of the sales, which means a profit margin of 5%. So this is compute the investment turnover, and that is calculated by taking the invested assets and over the sales, and you calculate that by dividing sales by the 180. So you are taking 720,000 and dividing it by your invested assets, and you're getting a turnover, investment turnover, so to speak, of 4. So compute the rate of return on investment. Now, how do I figure that? Well, I just figured the two top ones I'm going to show you. You're going to take the profit margin and multiply it times the turnover and come up with a 20% rate of return. So, and I think that is, yes, that is exactly how we did it. So, different ways of looking at these returns. And finally, we have a residual. And I'm going to let you try to figure this one out yourself. You've got a targeted return. And you know what your targeted return is? It's 10% on assets you have a targeted income, let's see, of, you've got 90,000. I'm not sure how I did this, guys, so maybe you won't do it on your own. Let's see what we did with this. So I have assets of 450,000, and I'm asking for the residual income. I have a targeted return of 4,500, and that's calculated by taking that 450 times 10%. So I have a target income of 45,000. I have an operating income right now of 90,000. So if I subtract the targeted income of 45,000, I come up with a residual income of 45,000. Kind of a backdoor way of doing that. Basically what you're doing is finding the target income. What is your operating income? So if I subtract that targeted income, then I come up with the residual. And that is decentralized operations as you look at it.